Good morning. This is Ken Long from Tortoise Capital with a review of the weekly trading plan for October 12th, 2012. We have a market that has moved into bullish normal conditions from bullish quiet. On an annual basis, using weekly RSI 14, we're at 59 out of 100, so in the middle of neutral. And on a 10-day NDX, we close with a minor breakdown from 10-day lows with a reading of -5 in the red. Percent stretch relative to the 200-day moving average is a yellow bullish at 5.07%, so we have about a 3% cushion to sideways market conditions. Slope of the 50 is white bullish, has pulled back to 0.43%. ADX has declined to 21.3, is now no longer trending, it's in neutral condition. And the ATR percentage has inched up to 0.97%, and that's why we're back into normal. No change in the blended monthly rebalancing holdings. Energy, gold, and Asia less Japan for the 26 ETF portfolio. The 13 ETF portfolio is Australia, Asia less Japan, and technology. Next reevaluation on or about 1 November. ETF 2, theoretical exposure of the model is 90%. The model portfolio itself will be at 100% exposed. There are now 3 ETFs in the 13 ETF portfolio on cash. That's real estate, treasuries, and Japan. In the 26, it's real estate, treasuries, Japan, and agriculture. And you will recall about 6 weeks ago, those were all near the top of the stack. And that's the current lineup based on their ranking as defined by the blended monthly percentage. In the market health check, vertical blue lines are 10, 20, and 30 days of look back. Horizontal purple line at 147 and some change was the swing high achieved in mid-September. The blue river is the 30-period Bollinger Band plus or minus 1 standard deviation. Solid green is the 10-period moving average. The thin red is 50-period moving average. The black line in the center is the 30-day regression line. The outside black lines are the channel that are formed by the maximum excursion from the regression line during the look-back period, which happened back here on the breakout based on the ECB announcement. Excuse me. Thick red line is the 200-day moving average, and underneath that is official, bearish activity, price below 200. From the swing high, we hang a 5 and a 10% pullback from the recent swing high, and interpreted as 0 to 5% is normal noise. Between 5 and 10 would be a correction in a bull, and beyond that would be defined as bear, according to conventional wisdom. I've highlighted 2 regions, a greenish and a yellowish. This long period of yellow was looked to me like a sideways quiet channel, and then there was the breakout from the ECB, and then this was the Fed announcement here about basically unlimited credit also, and it looked for a while like there was going to be a breakout. It has been no follow through. This is starting to take on the same qualities as the previous sideways quiet channel, and really I expect it to stay here, as we've been saying in the previous weeklies, and it's just because of the uncertainty of the election and this the overhanging sequestration decision that follows shortly thereafter in January. Both of those things got to be resolved for there to be, clarity about market direction. So we're at we pulled back to oversold on Williams percent R. The jaws of PPO are still pointing downward. We're at key support levels here, I think at about 143.5, which lines up with the bottom of the river, the 50-day moving average, the bottom of the regression channel. And so this would be a natural place for it to fail. If it fails from there, I think it gets to 139 pretty quickly, where it finds support from the previous channel. And if that fails, you can see the other, there's one more at about 137 and 3/4, not much. And then I think it gets, if it fails through 139, it gets back to test the 200-day moving average once again. which would sort of give back all of the grinding upward movement of the last couple of months. ETF2 regional report. You can see we've got Japan is on a cash signal, so that leads us to 90% in the model would say 90% invested, 10% cash. The two weakest are Japan and Latin America. The two strongest are SPY and the Qs. SPY is slightly stronger because 59 better than 57. And the S&P is slightly better than the globals at 59, better than 57, although the Europeans are catching up with, in IEV, as you can see, the 67 is better than S&P's 59. I guess that, now that I look at it a little more carefully, that should really say Asia less Japan and Europe. Force of habit. World market model, everything Europe, and only selected spots Australia and India in Asia. All of the U.S. is now below average except for the large value and large blend. Silver and gold still strong. You can see the pullback in real estate. Mexico in the Western Hemisphere. Financials have made a nice move here, especially the European banks. And the defensive plays, really, they're below average except for healthcare. So a market that has it's poised for transition. ETF top 30 sorted by the strength rating: natural gas, home construction, gold miners, silver. Spain, Italy. You wouldn't necessarily have thought that would be the case 3 and 6 months ago, but there you are. Inside the Dow 30, the winners continue to win: Home Depot, General Electric, Bank of America, Merck, Pfizer, Morgan, Disney. At the bottom, Hewlett-Packard continues to suffer: Intel, Caterpillar, Boeing, and Microsoft. It's hard to see any strength in the U.S. economy with those big fat names there doing so poorly. All of those are below their 4-month moving average, and so, in my view, are opportunities for some value plays. ETF liquidity, just to give you a quick summary of the average daily dollar volume of the last 30 days compared to the ATR percentage of the top 30 most liquid ETFs. Regression line crossover in the river. You can see the S&P has rolled over, has made a lower low with the 10-period regression, as has IWM. Gold has pulled off and leveled, but is still within the river, and the 30 is still outside of the river, so it's a pause that refreshes. Treasuries are poised. They've found support here in this 123 area or above 120, and if we see some weakness here due to the election in the next couple of weeks, Treasuries could make another nice run up to 130. We'll leap ahead now to the daily report. I won't reread the top line. We'll go straight to the overreaction and channeling. Quite a few signals on both systems. You can see the volatility, which found a bottom around 0.7%. ATR has now crept back up into normal. Part of this is that we're dropping off high volatility days and adding low volatility days. So what used to feel like very, very quiet and low volatility has become the new normal. And that explains that's sort of the adaptive indicator in action. Market ADX has rolled down to about 21. You can see the bears are actually slightly in charge now over the bulls. When you link that up with increasing volatility, that's not good for the long side. Quite a few signals in channeling and overreaction across the board. Some triple screens in gold and finance. Finance would be worth looking at because of its recent strength, as you'll recall from the world market model. And then between triple screen and 551W, a handful of good choices here in the Dow, and a half a dozen setups on the auto framer, including Hewlett Packard, Disney, Technology, Home Depot, etc. A lot of things are testing out at better than 2 to 1 on the auto framer. A handful of dojis, lots of channeling and overreaction signals, and then still plenty in triple screen and 551W. Intel should be very interesting to you. It's been an exceptional loser and had a breakdown on Friday. Had an RSI of 2, ranks at 2.9 on the auto framer, and it's a max pain range compression candidate number 3. So a lot of good choices in here for our style of shorter term trading. In the ETFs, it's really kind of the same thing. Silver offers a possibility, has a low RSI 2, 2.5 on the auto framer. Number 1 on max pain range compression is channeling and overreaction, so that one will have my attention. But still plenty of choices in here as well. Financials give you a nice potential here with the triple screen as well. 30-day regression line, you see the failure of the last 6 days brings it back to important support levels at 143. Failure there gets it to 139 quickly, like we saw on the health check. You see the slope of the regression line compared to its 10 period, it has rolled over, is now back below the 6-month average and coming back almost towards flat, which would be the dotted line. That's that's a definite warning to the downside. And you can see how it's rolled over. It has never really been able to get back above the full 1 standard deviation move here. So it's predicting more weakness. You can see the percent stretch compared to the 200-day moving average is now below average. This move back here to the red dotted line would be where it would actually come back to test the 200-day moving average. See, this is the one that happened in June, and a choppy but upward baby bull there. And now it's failed, and now that it's below this line, and only 5% away from the 200, definite yellow warning, yellow alerts. The Z-scores of the regression lines, the 90 has now rolled over in its little oscillation here, and you can see the steam coming out of it. The 10 is now down near its -1. The 30 has rolled over, coming back to 0. See the regression line has come well back into the river. I guess the price well back into the river, and testing the bottom of the channel. And the last time it did that, you can see that was the test of the 200. So there's another easy 5% loss in there if history just repeats itself. Just some reference charts that we use for our intradays. This is nice here, IEV. Notice the high signal to noise ratio. That is typical of a strongly trending market where it's getting a lot of directional movement during the day. More references. In the relative strength inside the U.S., it's the Dow, and the risk-off trades are failing compared to the market. So it's the risk-off is being favored, risk-on is failing. The commodities have made nice plays. Look at that nice move in oil in terms of relative strength compared to the S&P. And for those of you that have attended the workshops, you know how to interpret these charts, which I will just leave on for reference. I want to shift over now to a use of the regression line crossover. And this was some analysis we did in the chat room. We wanted to look at multiple time frames. So we moved out from our 3-minute period, and we took a look at hourly charts here. We went back 4 weeks, and we were considering the importance of this failure at 143 inside the S&P, and it ended up closing just under 143. But 4 weeks on the hourly, you can see the river has rolled over. We had a regression line crossover up here and has failed sharply from 147 all the way down to 143. And now what you have is trending behavior because you have price the ribbon, which is the 2-period Bollinger Band, then both regression lines, all outside of the river, making a new low, failing to hold at this double bottom. And so on an hourly chart, that didn't look very promising. We then dialed up to weekly charts and 4 years. And what we were looking at on the weekly chart, where what we have was a regression line crossover, and then price has come down to retest the high of the river. And so we just did the nearest neighbor look back and found other places where it's done that here. And there was a fail to the bottom of the river. Here, there was a fail through the bottom of the river and a big fail. Here, and there was a fail to the bottom of the river. Here, there was a fail down to just above the Bollinger Band median, and then a reversal and a move higher. Here, fail down to the bottom of the river, another failure at the mean, and a big fail before resuming. So there's precedent for doom and gloom there. Then if you go back to, take the intermediate time frame and just look at 6 months of look back on the daily charts, I see some danger here. You know, what goes up might come down and faster. So if we look at this last failure at the edge of the river and sold off, this was the test of the 200-day moving average back in the day at 128 in late May. Had a regression line crossover. And then as it started fighting its way forward here, but never again leaving this southern part of the river, you have a series of higher lows, including this one, which was, if you look just at the ribbon instead of the fat tail, was that could be 2 higher lows. A higher low, a higher low, a higher low. Then the first one that was not a higher low that came back and tested the river, then made a lower high. Let me see. See if we can get this a little easier for you to see. And now what you can see, from a distance, step back a little bit. Now what you have was the first lower high, and now a lower low, and now a lower low that is just outside of the river. And so if we just using our standard support and resistance for price targeting, you can see about at 140 it would be strong support. I'd see support at 136, 134, 130, and then all the way back to 128. So the danger in here. That's the first half of the upside down cup forming. So that's got that should concern us. Let's see. Let me shift back now to an intraday trade since we have it up. So intraday we were looking at UVXY, the double VIX ETF, and set it up for a SQC. Sideways quiet channel, and that was Friday, 2012, October 12th, and the symbol UVXY. And so we started stalking it here when SQC began, which is defined as both regression lines and price inside the river narrowing, and the slope of the river, which is that red line in the middle, approximating 0, so it's starting to get flat. So it stays in sideways quiet channel this whole period of time, and then breaks out here at 29.65 for an entry with a stop. You could either go at 29.40, which would be a 25-cent stop, or a 40-cent stop down here. Or if you really want to be tight below the Bollinger Band mean, pick the one that meets your risk tolerance, I guess. And then you can see the VWAP, volume weighted average price here. So an entry at about 29.65. Now, what that looks like on a larger scale was inside this window here. What I didn't show in that other one was that we had been making some trades earlier. This is 3-minute charts for the whole day for Friday. Now, stock charts won't give you the regression line signals. So I'm using this percent price oscillator set at 10, 20, and 8 to approximate the the crossover points, and you'll see some nice trades on that. Let me add a line so it's a little bit easier to see. So the regression line crossover would have occurred approximately where the blue line is and the where the PPO crossover occurs. It tells you that the move is about over when the next crossover occurs. Your potential signals for entry, and I've identified 4 of them here. Price in the ribbon at Bollinger Band 2, that faint orange in the background. Entering the river. I like that it found with a stop down here below the swing low. I like that after it entered the river, it held this support right here. And then it comes to the mean and holds. There's a potential entry. The pullback does not violate the Bollinger Band mean. By the time it does that, you can see that the mean has flattened out. So it's sold off, and then you get into this choppy area, and then a clear signal when price now leaves the river. And in that case, you could actually put your stop here at the first, just below the mean, and get a 25-cent stop, or you could use the bottom of the river or the swing low, or you could use the intraday low. Any one of those will get you into a reasonable trade that moves up fast, holds, moves up fast, holds, and then starts decaying. And then by the time the jaws of PPO closed, the regression lines would have closed, and the price re-entering the river. And there, what we look at is a reversion to the mean is the most likely thing to happen. It didn't fail out of the river, but it just went sideways, and that's where it went into that setup that you saw on. Let's see, where's that one? On this, that if we zoomed in, that's where we'd see the SQC forming the way we normally trade that. Then with your entry at 29.65, then you get this little move right here. Now the interesting. I think you can still use the MACD histogram crossover somewhere around in here. You'll see the MACD histogram is telling you have to be interested in the potential upward move. Now there wasn't as much follow through, but then that's in the afternoon on a Friday, so that's really not so surprising. So by the time the crossover occurs here, you can have this kind of a move. And so you'd have been looking at exits somewhere around in here, exits somewhere around in here, not later than that. And then for the rest of the day, it just kind of sideways choppy. But where that leaves us on a daily basis is a market that's right at the bottom. And so if we do get failure below 142 here, then it's going to be a quick rush to 140, looking on the dailies, and you would see the UVXY really take off because of the increasing amount of fear. So the point to show you there is just how the RLCO and the SQC fit together, and a proxy that you can use for the regression line crossovers. If you can't get regression lines on your charting package, you can get pretty close with this percent price oscillator with 10, 20, and 8 on the 3-minute charts, which is about the equivalent of the MACD histogram. It's computed the same way, but with a percentage instead of straight dollar figures. So that's the daily or the weekly report review for Tortoise Capital. We're getting ready to go down and play a game to see if we can make it into the finals for this weekend's tournament with the mighty Leavenworth Thunder U14 Girls Soccer Club. So we'll see you in the chat room. Good trading. Keep your profit targets identified and your risk measured, and know your reward to risk ratios. Bye.